All right, today we're cracking open a book that Warren Buffett himself called, quote, by far the best book on investing ever written. We're going to dive into Benjamin Graham's masterpiece, The Intelligent Investor, and pull out a framework for financial sanity in a market that often feels completely insane.
So let me ask you something. Does that daily roller coaster of the stock market just leave you feeling kind of dizzy, maybe a little anxious? You see a stock shoot to the moon one day and then crash and burn the next. It is so hard not to get sucked into that emotional vortex. If that sounds even a little familiar, trust me, you are definitely not alone.
And look, this is not a new problem, not at all. I mean, think back to the dot-com bubble. You had analysts on TV saying it was a new world order and that old school things like profits didn't matter anymore. Yeah, we all know how that story ended, right? The technology changes, the hype changes, but that fundamental battle inside our own heads between emotion and logic, that is constant.
Okay, so let's introduce our guide through all this chaos. The man himself, Benjamin Graham. Now, this guy wasn't just some academic in an ivory tower. His entire philosophy was forged in the fire of real-world experience, including the single biggest market meltdown in modern history, the Wall Street crash of 1929.
Sure, he was a professor at Columbia, but his real education came from the market itself. I mean, he watched his own family lose everything, and then he witnessed the complete devastation of the '29 crash. So his entire approach, it all boiled down to one central idea: protecting your capital. It wasn't about getting rich quick, it was all about not going broke.
And his most famous student, a young guy named Warren Buffett, really took that lesson to heart. In fact, get this, Buffett was so desperate to learn from Graham that he offered to work for him for free. You know what Graham told him? You're overpriced. He didn't actually hire him for another 3 years. I mean, that tells you everything you need to know about how serious this guy was about value.
Okay, so this all sounds great, but how do you actually practice this kind of discipline when everyone else is freaking out? Graham knew we needed a mental tool. He came up with this brilliant allegory. He said, stop thinking of the market as this big, scary, all-knowing thing. Instead, picture it as a person, a very particular business partner. So let's meet Mr. Market.
So picture this. You're in business with this guy, Mr. Market, and every single day, without fail, he comes to you and he offers you a price. He'll either buy your shares from you or he'll sell you his. But here's the thing about your partner, Mr. Market. He's incredibly moody.
Some days, he shows up just totally euphoric, practically bursting with optimism. On those days, he'll offer you ridiculously high prices for your shares. But on other days, oh boy, he's a total wreck, gripped by fear and pessimism, and he'll offer to sell you his shares for pennies on the dollar. The guy's all over the map.
So here's the brilliant part. You don't have to listen to him, ever. You're completely free to just ignore him. His daily quotes aren't a command, they're an opportunity. The intelligent investor sees his wild mood swings and thinks, great. You sell to him when he's euphoric and buy from him when he's depressed. The key is, Mr. Market is there to serve you, not to guide you.
Now, this idea leads us straight to Graham's next big concept. Because if you're going to take advantage of Mr. Market when he's having a bad day, you need to know what a real bargain actually looks like. And that brings us to the absolute cornerstone of his entire philosophy, the margin of safety.
It's called the margin of safety, and the idea is actually pretty simple. First, you do your homework to figure out what a business is really worth, its intrinsic value, based on its assets, its earnings, the whole shebang. Then, you just wait. You wait until Mr. Market, in one of his depressed funks, offers you a price that's way, way below that value.
I love this analogy. Think of it as buying a dollar for 50 cents. That's it. That's the margin of safety in a nutshell. It's not just about finding a good business. It's about buying that good business at a fantastic price. That discount, that 50 cents you saved, that's your cushion. It's your buffer if you made a mistake in your analysis, or if things just go wrong. It's your built-in room for error.
Graham even put a number to it. He basically said, as a rule of thumb, you shouldn't be any more than 2/3 of what you figure the business is actually worth. So that 33% discount, that's your safety net. It's like building a bridge designed to hold 15 tons, even though you only ever expect 10-ton trucks to cross it. You build in that margin, just in case. So, when you put these two ideas together, understanding Mr. Market's moods and always demanding a margin of safety, it forces you to ask yourself a really fundamental question. A question that Graham believed every single person in the market needs to answer for themselves. Are you an investor or are you a speculator?
Graham's definition here is it's crystal clear, and it cuts right to the bone. He says an investment promises two things:
safety of your original money, and a decent return. And it has to be based on thorough analysis. If what you're doing doesn't meet all of those requirements, well, then you're not investing. You're speculating.
And this table here just lays it all out, plain and simple. Just look at the focus. The investor cares about the intrinsic value of the business. The speculator, they only care about the fluctuating stock price. The goal for an investor is safety first, then a good return. For the speculator, it's just about maximum profit, usually with maximum risk. And the method, deep analysis versus just trying to guess market trends. You got to be honest with yourself. Which column sounds more like you?
Now, you might be thinking, okay, this sounds good in theory, but does it actually work in the real world? Well, let me tell you, this framework didn't just stay in a book. It sparked a revolution in thinking that has created some of the wealthiest, most successful financial minds in history. I mean, just look at this list. It is an absolute hall of fame of investing. You've got Buffett and Munger, Peter Lynch, John Templeton. The list goes on. And what do all these legends have in common? They all started with Graham's core principles, Mr. Market and the margin of safety. They prove this stuff works.
And think about this for a second. Back in Graham's day, Mr. Market might show up once a day in the newspaper. Today, he's in your pocket, screaming at you from your phone 24/7. With all this constant noise and hype and high-speed trading, a rational framework like this isn't just nice to have. It's absolutely essential for your financial survival.
So, I'll just leave you with this final thought. Graham's wisdom doesn't just give you a set of rules. It completely changes your perspective. It's a mental toolkit that helps you stay calm when everyone else is panicking. So the next time the headlines are screaming about a market crash and Mr. Market is having a total meltdown, what will you see? Will you see a crisis to be afraid of or an opportunity to grab with both hands?